Hello. Taiwan Semiconductor Manufacturing Company, or TSM, is actually up quite significantly today, up about 10%, after Warren Buffett announced that he's getting a piece of the company. So let's take a look at the details, what happened there, and what's with this company. Is it a good buy right here? So chip giant TSMC shares surge on Buffett's stake. And semiconductors has been a space that I kind of start to like quite significantly. And this actually shows in the portfolio video that I made. Three of my stocks were actually semiconductors. I think they are a nice play for the long term. Now this one, is TSMC, is one that I did add in my portfolio as well, like a month ago when I made this video. I will link at the end, by the way, in case you are interested in watching this one. But shares in Taiwan's TSMC soared on Tuesday after Warren Buffett's Berkshire Hathaway confirmed it had taken a close to $5 billion stake in a major boost of confidence to the semiconductor giant. I believe they owned a little bit already, and they got like four more billion, something of that sort. And you will see that TSMC is basically operating the world's largest silicon water factories and produces some of the most advanced microchips. So it's almost like a monopoly here. It's a company that is very, very difficult to duplicate, is the thing. Now, the company's sales and profits soared for the first 2 years of the coronavirus pandemic during a global shortage of semiconductors. Then there was a little bit of a decline, as you'll see here. The climb came to an end this year as demand was clipped and the prospect of a global downturn loomed, with the firm's shares down 24% and about 230 billion wiped from its valuation. Now, that actually you will see here that was pretty much a little bit of a surge in investor buying as the company was up quite significantly after Warren Buffett announced that they are acquiring about 60 million shares over here of the depository ones, the ADRs over here. And we'll see how that's gonna do. But what we do want to examine here is basically what the company is, where the company is at in terms of its valuation. It's not a super cheap company, but it's amazing value is the thing. And you'll see here that it's down actually 50% from its 1 year high, that is. And if you take it back 5 years, you'll kind of see how it has been trending down. So it does appear like it could be an interesting opportunity actually after it has been down quite significantly from its high. And again, 10 up today, taking to about $80 over here. Similar to Alibaba, actually probably about the same price. Now, P ratio, you will see that it is sitting at 15.6. And it has been going down, which basically shows you that the company is doing better in terms of its valuation. Yet the price to free cash flow is expensive, and the thing and the main reason behind this one, remember this is a semiconductors company, very large capital expenditures here is the thing with these kinds of companies. Outstanding shares that have been at about the same level, slightly lower, and total liabilities a little bit elevated compared to the free cash flow that the company generates. Again, this is kind of typical for this kind of industry here. There is a lot of cash burn because of the expenditures, capital expenditures, and that's to be expected. Yet the company has been growing its revenues at a tremendous pace, and it's already a pretty huge company. And the same thing with the net income growth over here. You can kind of see it over here. Again, the free cash flow is gonna be hurting a little bit. That's come to be expected with these kinds of companies again. And the total equity growth here also growing pretty nicely for this company. Another fantastic thing over here is the net income margins. The margins of the company are tremendous, sitting at near 40%, and very little debt here. Great returns on equity with little debt, which is always very, very nice to see. And a dividend yield that the company is paying, we can kind of see it here in the dividends tab. You will see that over here the company is paying some dividends. They are a little bit, I would say, not canonical over here. But 2.5%, again, if we take it back, you will see that it is about 33% of their net income pretty much, and quite a lot of their free cash flow over here. Now, I don't think this is a dividend that is going to be like canonical. Again, you will see over here that some years they have been paying it, some years they haven't been paying it. So I don't think that this is going to be necessarily expected from investors. It's almost like sort of like a special dividend case. Again, you can kind of see it in the dates here. It's not canonical like 2020, 2021 has been, and lately in 2022. But the previous years, you will see that it has been a little bit, pretty much here and there. Okay. So the next thing that I want to be taking a little bit of a look at is the financial statements and income statement over here. you will see from 33 billion taking it up to 57, almost 57.5 over here. And in terms of the net income that the company generates, from 11 billion to 21, so pretty much almost doubling it over here. Very nice things to see, very nice results from the company. In terms of its balance sheet, again, you will see that the total equity has been climbing upwards, 50 billion over here, 78 over here. So again, pretty much almost like 50% more. Total liabilities have been climbing quite a lot. You will see that it is sitting at 57 billion over here, starting from 16. So the company's expenses have been increasing, and that's something to pay attention to. There's quite some debt over here piling up, as you'll see, from year to year. In terms of the cash flow, you will see that the company's operating cash flow is increasing, 20 billion here, 18, 20, 29 and 40, increasing massively over here. Again, that's something that happened during the pandemic, but I think it's a trend that is going to continue for these kinds of companies, especially after they have been bust significantly in the past few months or so. And, pretty much when the economy kind of comes to its senses, I would say, this is probably going to be a company that's going to be soaring, I would think. And in terms of capital expenditures, 11 billion over here to 30. Again, a steep increase here in capital expenditure. It's something to be expected. Capex of these companies is a lot and would potentially keep increasing as the company is making more money as well. So, cash flow may not tell you the full story in these kinds of companies. It is quite a lot and it is to be expected. So it's always beneficial to also be taking a look at what the company is doing in terms of its net income here and its operating cash flow. And in terms of its free cash flow, you will see over here 8 billion 4 over here, 10 and pretty much again 9.5 due to capital expenditures, due to the high capital expenditures. And if we take it to our stock evaluation tool, it can tell us a little bit of a story here on what is going on with the company. Take a look at these increases over here, pretty insane. The increases in terms of the revenue of the company. Of course, this is something that we will not be using in our tool. We're going to go lower. So let's go 5, 7, and 9 over here. In terms of the net income margins, the company has been doing almost 40 lately. So I think I'm going to go 36, 37, and 38. And the free cash flow margins, now this is a little bit of a problem here because the company has some years where it's making less, has some years where it's making more. It is a company that is spending a ton in capital expenditures, so it does make sense to go lower. You could go somewhere in between, for instance, in between these values over here. So maybe go something like, let's go 50, 60, and 70. And of course, this restricted free cash flow will bring down the valuation of the company for sure when we derive our annual results. Typically, a company will be expected to have something between 80, 90, and 100. And that's happening again because the company is spending a ton in capital expenditures. So you may be okay with that, you may not be okay with that, but bear in mind that the fact that the company is actually keeping less because of its keeping less free cash flow, that is, because of its capex, could actually affect your results, your results in the discounted cash flow model. Now, if we hit calculate here, you will see that it does affect the results. We are getting 32, 44, 57 over here, and 72 is the current price, with 80 potentially being the new one. But if we take it to something that is a little bit more typical of a company, 80, 90, and 100, it is only then when you will be getting something that is near green. So bear that in mind again. The free cash flow that the company generates is limited because of the fact that the company has capital expenditures, high capital expenditures. Yet I think that it is a company that I would be adding to my portfolio because there are so many other nice aspects of the company, even though it is a little bit overvalued for sure. The fact that in terms of its net income, it's not that overvalued, frankly. It's basically after the capital expenditures are included where it actually becomes slightly overvalued. And the fact that the company has no debt, great returns on equity without any debt, and amazing margins. I love these kinds of margins, and still growing with, again, being a pretty solid company already, a pretty big one. And paying a little bit of a dividend, which doesn't seem to be a steady thing, frankly. But everything is looking pretty nicely here, and I think I would like to get a little bit of it. And this is why I added it to my portfolio. Again, the portfolio video that I made 1 or 2 months ago, something of that sort. I like this company. I like the sector for the long run, frankly. And even though it may be a little bit expensive, like when I did the video, I think it was like about 70 or something of that sort, maybe a little bit less when I made the portfolio video. You can take a look at it right after. but it was a price where I think that I would definitely add some to my portfolio. Right now at 80, it's a little bit more expensive, yet still potentially interesting. Now you'd have to decide, of course, but I want to thank you for watching my video over here. And again, remember to like and subscribe if you're not a subscriber already. And as usual, you can become a patron and get access to this tool, pretty much everything that I'm using over here. And I'll see you in the very next video. Bye bye.